Hi, welcome to this video. We're going to discuss now the basic tools of finance. This is chapter 27. Remember, this is a book of Gregory Mankiw, Principles of Economics. So, first of all, it is important that even without studying finance properly, we have been in touch with this field all the time. We have some relationship with financial system in some way. For example, I would say that most of you have already talked about savings, or you know more or less about that. So saving is naturally related with the financial system. Or maybe you have listened about mortgage. This, which is the credit when you ask for, when you need to acquire a new house, for example. So maybe in a job, maybe you have the decision when you already have this saving to invest your money in different instrument to have some return in change. And then we already know that there is some intrinsic relation between time and risk. Then this is like kind of the trade-off of this situation. So another thing is like economics, even finance is another part or another history, another story. The point here is like finance is so important to understand economics, and then we can define the finance as the field that studies how people make decisions regarding the allocation of resources over time and the handling of risk. Then, first of all, in order to introduce this part, we need to present the term present value as the way of measuring the time value of money. So this this comes from the idea that naturally the money today, the same amount of money today, and we have the same amount in 10 years, naturally they are not the same. So if we compare $100 today and we compare $100 in 10 years, most of the times this is not exactly the same. So maybe you can think that in normal conditions it is better to have them today than 100 in 10 years, because naturally money today is more valuable than the same amount in the future. What about if we talk about $100 and $200? Maybe the question uh, becomes like kind of tricky, because with this present value we have the instrument to compare two amounts of money in different points of time. So then we can we really can understand which is better, if the option 100 today or 200 in 10 years. So the present value answer this question. So basically brings the value of a future amount in terms of current amount. On the other side, when we talk about future value, it allows us to carry then the value of a current amount in terms of future amount. But then it makes comparable from the money in different period of time. So imagine that you put 100 in a bank account today. So how much will it be worth in N years? That is, what will be the future value of these $100? Imagine the situation that we have an interest rate of 5%, and then this pays annually, and then is what we call compound interest, which is a compound rate. So then, after the first period, naturally you will have the same $100 plus this return or this yield provided by this interest rate, which should be $100 times R, which is 5% or exactly 0.05. So then after 1 year, if you collect the terms, these 100 you collected, this expression is exactly the same as this before. So then here we have the situation for 1 year. Imagine the situation of 2 years. Then this is going to be provided by the first year, obtained the first year, plus the same quantity times the interest rate. It's exactly the same as this year. Then this is the taking the returns of the second year. So as you can notice, this is terms 100 times 1 plus R is exactly the same as this one. So then you can collect the terms. So when you collect the terms, you have 100 times 1 plus R times 1 plus R. How do you know that this is okay? Basically, if you multiply this by the first, you obtain this plus this by times R, you get this part. So then this operation is equal. And remember, when you have A times A, you have A squared. So then you have 1 plus R elevated to 2. So then this should be 3 and this should be n years. So for this reason, this is the equation for actually the future value of this $100. You can put here any present value. This is a standard equation. Then 5% in 10 years should be 5% elevated to 10, and then you have 1 plus 0.05 elevated to 10. We have this factor, and then we multiply the 100, and you obtain after 10 years with an interest rate of 5%, you obtain 162. And then this is the value of the 100 in 10 years. Compare naturally with the 200, which was the question, then definitely should be better 200 in 10 years, right? Because you will obtain less with the 100. Now imagine that question. Now suppose you are going to be paid 200 in years. What is the present value of this future payment? That is, how much would you have to deposit in a bank right now to yield 200 in end years? So you already know this. The future value is exactly equal to the present value times 1 plus R elevated to n. So then what is the value of the present value? So we just collect and we isolate the present value. Then you have this one, A is equal to B, then B is equal to A. So then I just reorganize that expression, and then here I just this expression that is multiplying, it goes to the other side, dividing, and then you have this one, which is the expression of the present value. You just replace 200 over 1 plus R elevated to 10, and then you have this result, and then the answer should be 122. Naturally, 122 is higher than 100. So then with another method, we have discovered that $200 10 years is more valuable than 100 today. So then 122.7827 is the value of the $200 today. So naturally, it is better to receive this $200 in 10 years. So, as you have noticed, the answer of this should depend on the interest rate. The higher interest rate, then this should be a change, because when there is a higher interest rate, it is possible that the present value could be higher than this $200. Then this could be more attractive, this $100 today. So why do we care about it? So basically, this is really important. Maybe it's not like the theoretic of the other things that we have reviewed, because maybe we have like some utility in evaluation of projects. Because naturally, you know that if this project is better to become real or not depends on the interest rate and returns comparing with the interest rate that you will have or you will face in other projects. So we can define the interest rate as this the price of money. It's like the opportunity cost of using it. So when it raises, when the interest rate is higher, so people naturally they will demand less money because it's more expensive become or take a debt. Imagine this other situation. Suppose that you earn a lottery that it pays $1 million. But this is tricky because it pays with two ways. So first, they offer you 20,000 for 50 years. So naturally 50 times 20,000 it becomes $1 million. Or they offer you immediate payment of $400,000, which is better at 7%. So then you need to bring all of these 50 payments today with the equation of the present value which all of these payments one by one. So naturally this is kind of hard because, well, you need to compute with a calculator like 20,000 of the first payment bring to current, then plus the value of 2 plus the value of 3 until the value of 15. Actually, it will take you a lot of time. So we're going to make you in Excel. So in Excel should be something like this. You're going to receive these payments, which should be 20,000, and the interest rate should be 7%. So these 400,000 will be in the present value to 276,014, more or less. How we can create that? Well, we're going to make here. So first we need the years. Okay, obviously there are different methods to do it, but we're going just to make this one because it's the easiest to explain. So here we have 2. We just make this become 50. So we go here until 50. Then we already have this one. Then here we have the payments that you will receive, and here you have the interest rate, and here you have the present value. So we are just going to become this expression over here. So you know that should be the payment, right, over. So then you have this over 1 plus the interest rate that hopefully should be here, and you need to elevate this one to the period. You have something like that. If you make this, as you can see, let's put here the values. You have here 20,000. Here we have 7%, and here you have the sum of all these values. All these values should be on to here. Then you have all these values. As you can see here, it means that the first payment of 20,000, if you bring that of today from the first year, it is exactly the value of 18,691. If you make something like this, it doesn't work. Why? Because automatically it moves from this. So how you can fix that? Just this one, you put F4 and here F4, and then you're going to fix all the time these values. So then you're going to take again these two values. So you just take these two and put this one until 50, and then imagine this the interpretation of the 50th payment. So the $20,000 50 years ahead is exactly amount of taking $678 today. And then you have finally this value, which is exactly equal to this. Then you already have this solution for this situation in Excel, and you're not going to waste all your time. So then this is the value that we already took. And what is better? Naturally, it is better to take naturally this $400,000 today, because otherwise, if you receive 20,000, you're going to have at the end of the day this value, which is naturally lower than 400,000. So then it should be 400,000. Then now we're going to discuss about the magic compounding and the rule of 70, which is naturally related with the previous part. So imagine this example that we have two countries, one with 1%, another with 3% of economic growth. Remember economic growth. Economic growth is the increase of the gross domestic product from one period compared with other period. Most of the time we compare GDP in real terms because it doesn't take into account the nominal prices, it takes real prices. So now imagine the situation of two people with the same income. So Isela, which is 3%, and Diego with 1%. So imagine that we are going to compare the situation of them in 22 years, and they start with the same salary, which is 30,000. What about 40 years after? So Isela is going to have 30,000 times 1 plus the interest rate, which should be or the increase of the salary, which should be 3%, elevated to 40. And then Diego should be this one, 1%, and then you just multiply these and elevate it to 40, and then the other one exactly the same, and then you have this one. Naturally, you see here that 90 is much higher, even double the salary of Diego in 22 years. And then if you make the ratio, is like 2.19 times the salary. Isela's salary compares with Diego. So how many years the investment double? So should be the rule of 70. So you make 70 over in this situation you have like 3, which is the interest rate. So with an interest rate of 3% in 23.33 years, you will get double salary. And with salary of 1% increase, you will have 70 years. So this is the rule of 70, which is nice because you can know how many years it's going to take to double any quantity of money. So with this situation, we already have the part of how to move money and compare, and now we're going to talk about, we already talked about time, right? And then we're going to talk about the other coin, the other side of the coin, which is the risk. So how to manage risk. So naturally, you know, when we play soccer, we risk some injury, or when we commute, we risk some car accident, for example. It's like exactly the same in finance. When you invest in the stock market, you risk a fall in the prices. So obviously you don't necessarily avoid them. So you are not going to play soccer anymore, you're not going to commute anymore, or you are not going to invest in the stock market anymore. Obviously, this is not possible. So you need to manage that risk in some way. So it's what we call the risk aversion. The risk aversion is associated with people that they naturally dislike this uncertainty. Then, for example, imagine a simple game that toss a coin. So it gets heads, you will receive 1,000. Tails, you need to pay 1,000. So risk averse people wouldn't accept it. Why? Obviously, should be interpreted or analyzed with some models of risk, with the concept of utility. Remember that utility is some subjective measure of well-being of satisfaction. This is kind of hard to make comparison, but you can say that you prefer play soccer than playing basketball. In what way? This is so hard to make double, triple. This is so hard to measure and more in quantities, but you can say at least in original way. Something is better to other. And then here is a graph to understand better that situation. So we have in the y-axis the utility and we have the wealth. So then this is your curve of expected utility. So then imagine the situation that this is your current wealth. Naturally, if you gain 1,000, then you are going to have your current health plus 1,000. As you can see here, because this slope is lower than 1, so you're going to have an increase lower than the increase in the wealth. So this is the utility gain. What about if you lose? If you lose, you're going to take even, it's going to be even, you're going to have apparently like higher loss of utility. This is utility loss. So the point here is like the risk aversion makes more painful the loss compared with the gain. Naturally here, the utility gain is this one, but the utility loss is this one. So this averse, when you are risk averse, you fulfill the property of diminishing marginal utility. What's that? Remember, the utility of eating an additional ice cream when you are satisfied, maybe you're getting some satisfaction, but maybe it's starting to be lower and lower because you are already kind of satisfied. In this case, it's kind of the same. It's not like you don't like to become like richer. The point is like you value this loss like more than this gain. Then utility gets flatter and it increases the wealth. So this additional money, this is not going to provide like really additional utility too much. So then the risk aversion provides some important tool to start to analyze the other things that we're going to see in this chapter: insurance, diversification, and the risk return trade-off. So let's talk about the markets of insurance. So this is one way of manage risk, one way to deal the risk. So basically, the person need to pay a fee to become insured. So an insurance company agrees to share or to assume all the risk. That's the part. The other case you have, for example, car insurance. It covers the risk of you being in an auto accident. Fire insurance covers the risk that your house will burn down. Health insurance, you might need an expensive medical treatment, and with this one you will be covered and you don't need to spend too much. Life insurance covers the risk you die and you leave your family without your income. Travel insurance, well, actually, this is my company. Unfortunately, I'm not YouTuber 100%. I would like to, but I need to work. So this is my company, which is an insurance. Actually, it's American International Group. So make some advertisement. Anytime you have AIG in front of you, you would say, ah, that's the guy of YouTube, the Colombian guy. So that's nice. So I'm going to buy this one. That's funny. Also, this is my company. It's AIG. I work for travel insurance company, the Travel Guard part. So naturally, what we do, we charge person naturally a fee, and any circumstances that this person face, we're going to help them with the hospital coverage, with the evacuation, even unfortunately with the repatriation when unfortunately you can die in a trip. So then every insurance contract is like a gamble. maybe you won't be involved in any claim because maybe unfortunately you don't have like any claim. So you will just have in exchange peace in mind that you are covered. Then the basic idea of the insurance is like the risk is not covered. I mean, it's like it doesn't disappear. The point is like the risk is spread between a lot of people that they are going to assume that, but in small portion that is not going to be a big harm. So obviously, inside insurance market is not perfect. We have some troubles. For example, adverse selection, because naturally if you're a healthy person and you are you know that you don't need to go to hospital, maybe you will be tempted to avoid paying an insurance. Otherwise, the situation of unhealthy people that they really need to. So then, in some way, we are covering just people that likely they will suffer a claim. Other trouble of the insurance is moral hazard, because maybe when you have something like that, you don't care too much about, for example, when you're traveling, you know that you have maybe insurance company, or and maybe you will take some risk of eating on the street, for example. I don't know, that couldn't be my case, but some people do. So the point is like price of insurance reflect the risk it will face. So sometimes the high price of insurance make people don't buy an insurance. So now discuss about the diversification of firm specific risk. So some important and famous case is the Enron case, is a case of fraud. So then they have a lot of employees naturally, and the point is that they had their savings in stocks. So naturally when it gets like bankrupt, obviously your stocks they worth nothing. So then this is the old adverb. Don't put all your eggs in one basket. Is what we call diversification. Come on, you're working that company, you cannot have the same all your saving in stocks in this one. So insurance is a way of diversification. So this point is, for example, when you buy stocks in the stock market, it is better to have money in different companies and different industries. So maybe if some fall, they are compensated by other stocks. So risk we measure in finance usually with standard deviation. The standard deviation is not more than the volatility of a variable. If the standard deviation is higher, it means that your variable is more volatile. Obviously, so we have with this one is associated with return. So if the risk is higher that you are facing, probably the gain that you will expect is higher, but obviously the losses as well. So here is an example of an interesting graph. So here in the y-axis we have the risk, which is measured by the standard deviation of portfolio return. So here we have more risk when the standard deviation is high and less risk when it's lower. We have here the number of stocks in portfolio. So naturally, immediately when the number of stocks increases, the risk start to go down. However, it tends to 20 in this case. It means that there is some risk that you cannot avoid. Some intrinsic risk is what we call the risk market. So naturally, for example, you have single stock, you have a risk or standard deviation of 49%. So obviously it's impossible to eliminate all risk. Then something, the firm specific risk, which should be the uncertainty associated with a specific company, and this can be make some lower, but the market risk is associated with all economies, so we cannot avoid that risk. So this is the trade-off between risk and return. So is what we talked in the first video. People face trade-offs. So stocks usually offer better rates than bonds. How come? Basically, since stocks they provide around 8% in average, government bonds they provide 3%. The case of the return of 8%, we assume kind of deviation of 20%. And we assume a normal distribution. What is a normal distribution? Basically, that the data is distributed in that way. So here we have the media. So in the media. So we have here, well, actually the medium here. This is in Spanish. So medium. So we have here, and then we have here all 68% is concentrated in this part. 95% is concentrated in -2 or 2 standard deviation. So here we have 8% of the medium, and then we have here the normal distribution, which is deviation 20%. So we have two deviations, should be 40, 40 plus 8 should be 48%, and then you have here -32%. So automatically you know that all your stocks will be higher. You will receive 48%, but you can lose even 32%. So naturally with the bonds, the deviation should be lower and the exposure of the risk should be naturally lower. So here should be the standard deviation should be 20%, which is deviation times 2 plus the medium. You have 8%, so you have this 48%. On -32, we have the medium minus 20% times 2. Then you end up with -32%. So second possibility, we assume like 33%, which is zero risk. So here is like a combination. So you are going to combine stocks with bonds. So if you don't have no stocks, you are going to face approximately 3% per year. If you combine with 25% of your portfolio, you will take more return, but you are going to face higher risk. In the time you combine more and more and more stocks, and even when you have leaks 100%, you will have like 20 risk standard deviation. So this is to show you that when you start to mix risk with risk, maybe no risk instruments with riskier ones, the exposure to risk should be higher. Then we're going to start to talk about this asset valuation. Basically, the fundamental analysis is a way or instrument to make some asset valuation. So we already have seen the time and the risk. And then we are going to discuss a little bit what determines price of a stock. First of all, supply and demand. And there is another part which is more information. What is this information? So when you buy and share in a business, you need to verify if this is the real value of that stock. So if you value that this price is less than the real value, is when we talk that the stock is undervalued, and if the price is over the value, is overvalued. It is equal, we call fairly valued. Obviously, you prefer to undervalue stocks because you are buying under the real price. But this is the question. Determine this real value is the hard part. It's not easy. This value is definitely related with the profits and expected dividend. What is the dividend? It's like the division of the profits of a company, which is split in the shareholders. So obviously the profitability of a company depends on the products, on the competition, capital, and even whether workers are unionized, taxes, etc. So it's how you can determine the real value of a stock. So if we assume that everybody knows the same information, we are talking about the efficient markets hypothesis, because it follows the idea that the price reflects all public information available, so the price should be true. But the idea is like all stocks are fairly valued all the time because they reflect the real price in the markets. So in some way we can assume that the market value exhibits informational efficiency. However, we have noticed that stocks they follow a random walk. A random walk basically is a process that is impossible to predict with available information. So for this reason, it is better to buy a diversified portfolio. So in this way, maybe the efficient market hypothesis sometimes is true, but sometimes to be seen carefully, because unfortunately, sometimes there is a lot of speculators in the markets, and they have even more information than others, and they take advantage of that situation, and they make the day. So for this reason, maybe this price cannot be true sometimes. So for this reason, maybe the efficient market hypothesis cannot be true. So, and we need to take into account as well market irrationality, because efficient market hypothesis assumes people buy and sell stocks rationally, and we know that a lot of people they make some passion. So maybe, for example, sometimes when the price goes up without any fundamental analysis is a speculative bubble. So sometimes with fake news, with fake information, people start to buy or people start to sell some company when there is not real fundamental analysis for make that decision, is when speculative bubble are created. At the end of the day, if it's not really possible to predict the share, I mean the behavior of the market, otherwise everybody will become rich. Some people they are smarter and they have like better ways to predict it, but it's so hard to get it. So then, as a conclusion, we provided some financial tools to make some financial decision. Actually, we make this with the present value when we learned that a dollar in the future is less valuable than today. We provide some information about the risk management and some specific tools or ways to diversify it, and that risk averse people they can manage better sometimes. And we make some approach to the asset valuation which is associated with the future profitability. I hope it has helped. You have taken more idea about the basic tools of finance, and we're going to show some, as usual, some exercises. And I hope you have enjoyed and you have learned something. So I'm more than open to hear your comments. If you like it, thumbs up and subscribe. That's all. This is not like the real truth. I'm just like providing my opinion about the chapter. You have something else to say or something to correct me, I will be more than happy to hear you. Bye bye and see you next time.